Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny.
And we need your help. I want to do a thought experiment on if we've been valuing the market completely wrong for the last 20 years, but you have to leave your preconceived notions at the door. We're going to get started.
Two Super Guys Trade Stocks.
All right, so let me explain to you where I'm coming from, okay? I have been very bearish, as have you, for a while, right? But the market just isn't listening. So whenever that happens, I don't like being cornered into one point of view. So I tried to have like an internal argument with myself. So I said, all right, what if I tried to argue from a bull perspective? Because if I can argue from a bull perspective and it's a good argument, then I need to relook at this whole situation, right? If I can't put up a good argument, then I'm probably good to go. The problem is I did this in my head, and then I was like, oh man, I don't know what to think anymore. All right? So I'm going to say a lot of things that people probably disagree with. I want honest feedback, though. I want to know where you're coming from, because most of the people that watch this channel are bearish. Everyone's thinking that this is overvalued. I think most people in general think that this is overvalued. But just hear me out, and I just want to see kind of where we're at here. So this is me on the bearish scale. Dr. Pepper's there because it doesn't know like what flavor it is. It can't decide. So it's just neutral. It's Switzerland.
It's 23 flavors.
It's 23 flavors. All right. I would put I'm not crazy bearish. I don't think the end of days is coming, but I actually put you and me relatively similar. We're both bearish, but we don't think that we're going to go to like the SPY of 200, maybe like 380. Right?
Yeah.
Close? Okay.
Yeah, sure. I'd have to look at the S&P 500 earnings and we'd be able to give you an actual number, but get some room to go down.
Interesting.
There we go.
All right. Here's the SPY PE ratio, the average annual ratio per year since like 1880. Okay. Now, what do you think the average is?
So, there are really two different averages, right? There's like before like 1995, say, that's like 15. And then the more modern one is closer to like 18, somewhere in that ballpark.
Okay. I think that's you're actually pretty close. The S&P 500 PE ratio, the average is 16.01. But that's, since like 1890, right?
Yeah.
Now, here's the problem, okay? Every single date or every year below the mean starts from 1995 and lower. We have not had a year below that mean for almost 28 years. All right? Yep. That's disgusting. Now, let's take your number of 18, right? If we do 18, there is 1, 2, 3 times in the last like 27 years where we were actually below 18. Okay? In the last 10 years, we've only been below 20 twice.
Okay.
All right. So a lot of times when we look at value, I think we're being a little bit unfair. We're expecting some like Warren Buffett levels. Here, let me move my face. Like also, this is when Warren Buffett got loaded in like the 70s here when the PEs were 7.
Yeah, all you have to do is like open a book and actually be able to read and calculate a PE. You can make money in stocks. It's kind of funny because like they literally asked this question at the Berkshire Hathaway annual meeting. Is value investing dead? And he's like, no, people do stupid things, and that's where you get your value from. And people are doing more stupid things more often now. So there's still plenty of value investing to be had. So it's just the overall market on average is tough.
I'm not debating that, but I think the actually value number has changed. Okay. I want to look at some other factors here. So once again, just don't have any strong opinions. Just listen. So a study from Bloomberg Intelligence shows that during the first 6 months of 2020, retail investors were almost 20% of all stock market shares traded. All right. That's almost double from 10 years prior. That's a disgusting amount. All right. It did actually keep pace. So here's individual investors' share of U.S. equities trading volume by year. You can see 2011 hanging around 10%. Then we're up towards 23% in quarter 1, 21. That's a disgusting number. Before, retail investors did not have an ability to actually shake markets, right? This was an article from March 14th. According to Morgan Stanley, retail investors make up 10% of the total daily trading volume of the 3,000 biggest companies. So about 38 billion per day. That's disgusting.
So you know what I'm immediately thinking? Buy Tesla and nvda and just shut up about it.
Actually, I did not put that in this article, but that was the top 2 companies, I believe. So
yes, but of course.
Another thing here, according to a study published by Schwab, 15% of all investors started in 2020 and up. Okay? That is a very large number. Now, I want to look at ease of access and why I think it's possible that our traditional values of what value investing is just no longer applies, or our fundamentals, if you will. Okay?
Yeah, I understand.
The Revenue Act of 1978, that was the start of the 401k and the death of the pension, right? More and more people, after about 1980, started going to the stock market, okay? Now, we've showed this before. If you were to invest in the 80s, as a retail trader, you'd pay $200 for a commission, right? 90s is about $100. 2013, it's now free. I'm not saying I'm a huge Robinhood guy. I have Robinhood. They have some issues. But they are free, and it made the barrier to entry significantly easier. In addition, you now have a model that was never, by the way, 401ks are a scam for retirement accounts. Like, if you read back on this was never meant to be what it is today, but whatever. It wasn't supposed to replace pensions. Now you have all these people putting a portion into the market, and it has a pretty drastic effect. So here's 1990 and up, all right? So the pink, percentage of Americans with publicly traded stock holdings, goes from around 28% upwards to like 58 from 1990 and up. Okay? Almost double. That's disgusting. That's more and more money being pushed into the stock market, just over and over and over.
Particularly S&P 500 index funds, right?
Particular S&P 500 index funds. Now, you are familiar with this. Can you describe this?
Buffett indicator. Basically, you're looking at overall value as far as the stock market to GDP. So it's a total market capitalization in the United States. And then the GDP, it's the gross domestic product in the United States. It's trying to give you an overall relation of how expensive stocks are to the U.S. economy, health overall.
Okay, and the big problem with it, let me fix my voice. The big problem with it is it does not take into account international sales. It's American GDP, right? So this made a lot of sense before globalization happened, before the internet, and it was incredibly easy. I just bought something from Alibaba like 3 days ago, right? That was not a thing 20 years ago. You couldn't do it. So now it greatly skews that metric to where it almost doesn't even make sense. So here's direct investment by country. Okay, so the foreign direct investment in the United States increased 506.1 billion to 4.98 trillion at the end of 2021. All right?
Okay.
So they added another 500 billion in the matter of a year. That's gross. That's a large portion of the stock market. If you go back to, before the 401k and all that stuff to 1965, the yellow is foreign investment. Look at that giant chunk. All right? Yeah. That's all happening because of the internet. Right? It's all happening because of ease of access and the internet and globalization taking place. Okay. Now, I also want to talk about money supply.
Jesus Christ.
Okay? Investors have put more money into stocks in the last 5 months than the previous 12 years combined. Now, this is from April 9th, 2021. Right? Now, this is a little abnormal. It was a little bit crazy. Right?
Yeah.
So that number is not 100% where it's at right now. But this number was really iffy because you see articles saying 80% of all money was printed in the last 3 years, but it's not accurate. There's a lot of different percentages. This was the lowest one, and it also took into account quantitative easing and the infrastructure bill. But basically, Let me click on this. Monetizing 5.2 trillion in COVID relief increased their money supply by 27%, on top of the 4.5 trillion added to quantitative easing, another 2 trillion, and you have 35% increase in paper circulation.
It's wild.
Okay, we are being hit with multiple different areas. We have significantly more money added to the economy than ever before. It's never happened. It's a massive, massive amount. We have ease of access with significantly almost no trading commissions anymore. The internet allowing globalization of anyone. China can invest here. We can invest in China. We are investing in China, right? I think in one of those slides, like Ireland put up 100 billion last year in America. Like it's just, it's insane how much more money is coming into the market. And when you use traditional valuation metrics, none of that is accounted for. Literally zero, because all those metrics were created 50 years ago. So when you look at, well, we want a mean of 16. Let's even take your 18. We haven't touched 18. We've been hanging out in 22, which is like 23% above 18, just forever, for like the last 10 years. We only hit the mean since 1995. Now, granted, if you do PE by month, you do get a couple more. There's a couple months where we dropped below 16. I think there's like 2 quarters too. But in terms of year, it doesn't hold up. I don't think that we are taken into account, because it's always scary to kind of think differently, think like, all right, this is how it was, this is how it will always be. But we're not taking into account that there is piles and piles and piles of money that have been injected into the market just in the last 5 years. From whether it be foreign, COVID, infrastructure bills, quantitative easing, there's so much money. And it's not going anywhere, because you also have 30% more people than ever investing. Everyone's like, it's like a trendy thing to do. Now I want to make a caveat here. I'm taking nvda out of this conversation. That doesn't make any sense to me. And maybe Tesla, but the rest of the market, I think it's possible, if you try to argue from a bullish perspective, that you could make a case that the bottom was already in at that 350, and we could be going higher. So
I mean, we could be going higher. However, I would say that, you remember Michael Burry talking about the term that the mother of all bubbles?
I remember the tweet he followed it up with saying, congrats. There's never been a time since 1920 where buy the fucking dip actually ended a thing. So
Yep. Yeah. I mean, we are indeed in the buy the fucking dip generation, and mother of all bubbles can continue to inflate for a very, very long time. You have no idea how large this thing can get, to be honest.
True.
I would basically say that your arguments, to me, I could consider them to be just more evidence that we are indeed engaged in a continual expansion of the bubble that's been going on for the last 20 years, basically.
Yeah, but the internet's not a bubble. That's not going anywhere. Yeah, the ease of access is not going anywhere. The money that was printed is not going anywhere. The commission-free trading is not going anywhere, and foreign investment's not going anywhere. That's not going to decrease.
Okay. I'm not saying that it should, but I'm saying that the price to value ratio, basically, of what you're paying versus what you're getting, that continual separation is continuing, basically. So you're just seeing a divergence even more and more of the prices of assets going up compared to the actual value of the underlying asset, if you will.
But wouldn't that be inevitable if you have more and more people investing, putting more and more of their money? There aren't going to be less people investing. There's only going to be more people as we have more people.
Yeah. It's just they're coming further and further away from their underlying, like, bedrock kind of valuation, if you will.
All right. So where are you at in the scale? I still have you the same. Are you still the same?
I mean, yeah. I mean, I'm still bearish bias in that, like, I think we're overpaying for things at this point in time, and I think we will continue to overpay for things for quite a while. I'm not someone who's thinking doomsday scenarios or anything like that. but I certainly think we could still see a 20-30% stock market correction before the end of this year is my thought.
Wait, is that from where we're at now or from where we're at the beginning of the year?
Where we're at now.
Right now?
Because yeah.
Okay. All right. I don't know if I see it. I'm gonna be honest. Because if you can't pop a bubble that is gonna be permanent. It's not like the .com era where, all right, here's a good example. SPOCs, right? All of those companies, like Fubo that I was in, like so many of those companies, they're all dead, but the stock market's incredibly high. If you look up any company from 2020 with a Virgin Galactic, all those companies are dead. They're not dead, but they're negligible amount per share, right? No one's buying those. But the stock market's still this high because people are putting their money in AMD, Apple, Target, Costco, that kind of stuff, which they have solid sales.
No, there's a real thing there supporting it. I just think that real solid economy that's supporting it is going to continue to weaken as Jerome Powell.
I do think the economy. I do agree with that. I 100% agree with that. I don't think this is like a bubble because I don't know I don't know if I agree with that.
I don't think I'm not calling for a bubble bursting anytime soon or anything like that.
And but once again, this is NVIDIA's out because that is a bubble. I'm not 100%.
Yeah, I'm not arguing for a bubble to be bursting this year or like that. I don't think that's going to happen. But I'm thinking some kind of contraction in that separation between those two things of underlying kind of valuation versus asset prices. I think they'll come a little bit closer together at some point this year. And
I think it's possible. I don't think 30%.
I'm talking about overall the S&P 500 index fund bubble could be for the rest of our working lives. So it's kind of stupid to not continue to be investing in it. It's just a question of, building assets that are, a little bit more immune than the stock market and having a broadly diversified portfolio over time.
Yeah. So put all your money in Tesla is what you're saying.
Yes.
All right, guys.
Keychains. Tesla keychains.
Tesla keychains. All right. Let us know what you think. Like I said, I was just trying to argue against my own self, and it was kind of interesting. It was kind of weird. So let us know what you think, guys.